Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast. I'm Christian Allen. I'm here with my co-host. You know him as Rod the Pod Zabriskie. Rod, what's going on, my friend?
Hey, I'm doing great. How are you?
I'm really good, Rod. And I'm excited because today I'm going to ask you to put on your psychologist hat.
Yeah.
Do you have a psychologist hat? I probably should ask that first.
I didn't. But
you're going to? You're going to try?
Yeah.
All right. Well, that's not giving me the kind of confidence I wanted to kick off this show. My experience is that Rod is a natural psychologist. So especially as it relates to money, I think you're underselling yourself on this.
Well, here's the thing is I like to wax philosophical. So maybe I was putting myself too far. My bias was toward philosophy and maybe I need to pull it back.
Okay. All right. Well, we'll see where this takes us. So today, Rod, we're going to talk about the psychology of investing and specifically overcoming biases. But before we do that, I want to make sure that I remind everybody that we've got the virtual summit, the Invest with Benefits virtual summit, live on September 12th. You can register. We should put the registration link in the show notes too. We'll put the registration in the show notes. But we have emails going out. You can hit us on social media. You could email us. It's really easy to find it. But we're incredibly excited about the virtual summit. We busted out all the stops, starting with our keynote speaker. We got the legendary icon investor, Damon John, to do our keynote. And really, it's actually something a little bit different than a keynote, which is something I'm excited about. I've thought about this, and it's actually what we would qualify as a fireside chat, right?
Yeah.
So this is going to be more like a personal, Rod and I are going to basically interact with Damon on behalf of the listeners of the virtual summit. So we're going to be compiling questions. By the way, if you have questions, send them into Rod or I, Rod at moneyinsightsgroup.com, Christian at moneyinsightsgroup.com. Any questions that you have that you think would be interesting to ask Damon, we'll basically review all the questions that we get and ask the ones that, two-sided. One, the ones that we like the best, but also the ones that are probably the most common, right?
Yeah. Yep.
So that's going to be I just think it's going to be super cool. Obviously, everybody knows Damon. He started FUBU. He's been on Shark Tank for a decade and has really an incredible reputation as a prolific investor. So we thought, who better to kick off the Invest with Benefits Summit than someone who really knows what they're doing?
Absolutely. Yeah. I am really excited to have him there. And what's interesting is we wanted him to have him be our first speaker, but turns out that they're actually recording Shark Tank that day. So we're catching him on their lunch break. It's going to be kind of more middle of the day toward the end of the show, kind of as Eastern time. But The point is we've got him in there and we're excited to have him.
And I genuinely think it's kind of a cool, unique format. Like, I think I would rather have that kind of a format over just having like a talkie. Not that we wouldn't have been happy with that, but I think like having like a more interactive experience will be really cool. Yeah. Okay, so that's just one of the many speakers. It's a day that's like maybe overly jam-packed. We've got 15 speakers throughout the day. Rod, why don't just highlight a couple that are standing out to you that you think are cool?
Yeah.
By the way, we think all of them are cool. Let me be clear.
We'll highlight a few here. But if you go to investwithbenefits.com, you'll see the full listing out. But one that was kind of a late ad that I'm excited about is Alex Bean.
Alex Bean is super cool. So the story on Alex Bean, he reaches out to me through LinkedIn to connect with me over the pod, and I didn't know his name specifically. I did, however, know the company that he founded. So he founded a company, Divvy, in Salt Lake. This was, I guess, probably 7 or 8 years ago, maybe a little bit more, maybe not even that. Like, those things happen quickly. But here's the deal. Alex and his partner start Divvy. They raise a ton of capital. They're absolutely crushing it. They sell it for $2.4 billion to Bill.com. And then what Alex has done since then, he started a new company, Tandem. Tandem is specifically investors who want to invest in other founders, CEOs, and I should say founders, startups, that kind of thing. And I'm sure he's going to be focused specifically in the technology space. So it's a really unique and cool avenue. Obviously, we don't have that many people that have sold, have had billion-dollar exits in their history. So I think the experience that Alex brings, and he's a young dude, like he's just been crushing it. I think he's going to be a really cool ad.
Yeah. So he's on there. Lisa Chastain is one. Nelson Dellis.
Wait. Lisa Chastain is the not budget.
Yes.
The no budgeting.
Stop budgeting.
Yes. Stop budgeting expert. I'm missing the exact framework, but I love her framework because it fits with us so well. Yeah. I hate budgeting in the traditional sense. So she's going to teach you how to stop budgeting, but still crush it from an organization standpoint. Yeah. So Lisa Chastain is going to be a fun one too.
Yeah, so those are a few. I mentioned Nelson Dellis. He's a memory world champion. That's going to be fun to have him on and just kind of relating that specifically to what we're doing.
And Nelson's he's going to be a unique one because we wanted Nelson because it kind of breaks up some of what we're doing. Like most of it's going to be jam-packed financial experts, investment experts. Nelson is a memory expert. He's got a huge following. His influence has gone he's gone viral in a lot of situations. So Nelson's really cool. Go check him out on YouTube. You'll see what we'll kind of be getting. But it's going to be a unique, fun experience. So super excited to have Nelson. Okay, so we highlighted 3 or 4. Like I said, we've got 15 in total. So I think it's going to be fun. Like Absolutely. You said, go to investwithbenefits.com, check out our lineup. And again, it is on September 12th. Make sure you register. It's totally free. Rod, there's really no reason not to be at the virtual summit. It's just going to be awesome. Yep. Okay. Now that we've hit that, quick shout out, right? I keep meaning to do this at the beginning of the pod and then at the end, and I say shout out. This is a shout out to you and I. So this is great. Self shout out.
Okay.
Self shout out. I mean to do this, but I rarely do. So here's my request. If you listen to the pod regularly, you think what we do is cool, take 30 seconds and go give us a Google review. We don't ask for them often just because that's not really the way we roll, but it does help us grow and progress. So thank you. We appreciate all our listeners. Okay, now that we've done that stuff, let's get into the fun stuff. We're going to start talking about the actual psychological biases that we oftentimes fight when we're in the investment space. And here's the deal. This seems like an especially relevant topic, Rod, for a couple of reasons. So many of you that have worked with us over the years, we tend to obviously encourage people to work inside the alternative space in addition to what they're doing in the traditional space, right? We're not the people that say eliminate or completely get rid of it, but we're saying, hey, expand your horizons to the point where you're getting an opportunity to do this. Okay, but there's good and bad with everything that we do when it comes from an investing standpoint. And on both sides of the equation, both in the traditional and the alternative, we've seen some challenging times, right? Obviously, real estate just crushed it for years and years. And so we had this incredible bull run in the real estate market that made a lot of people really wealthy. And now at the same time, we've had some kind of challenging issues. And so things are a little bit different. I'm certain that people are having a lot of emotions going on in their mind. We know people who have lost money in real estate deals, or obviously there's a lot of situations where we could lose money, and people have. So the question is, how do we deal with those? Okay, and then before I finish, we've also seen in the last 3 or 4 days, this is just really fresh, really big hits on the equities market. So between Friday of last week and Monday, it was a massive hit. I think Japan had the largest hit since 1987 in their market. So it's been a global kind of, time of nerves, I guess, fear, right? All of those things. So anyway, we thought, what better time than to hit on this specific topic? Okay, Rod, what I want to do is I want to get in to what the biases are. Before I do that, is there any thoughts you want to add to what I shared?
Well, maybe we should define a psychological bias.
Good thought. Good start.
And again, talk about some of the common biases.
Okay.
But,
define it for us.
Okay, this is a detailed definition, so pay attention.
All right, spit it out, Rod.
Okay, systematic patterns of deviation from the norm or rationality in judgment leading to illogical inferences or conclusions.
Okay, so in simple terms.
In simple terms, we make dumb decisions based on irrationality.
Okay, irrationality leads us to poor decisions. That is absolutely true in the investment space, right?
Yeah.
Like without question, that like the definition of successful investing is buy low, sell high.
Yeah.
And interestingly enough, that's a lot harder than it sounds for most people. So, and that's why like there's those Dow bar studies, Rod, that show the difference between what like the markets actually perform and what people's returns in the market are. Yeah. So there's this huge gap, and you have to ask yourself, like, what is it that's, you know, creating that gap? If the markets are averaging 8, 9, 10% and people are only getting 3.4%, it's something like that. That may not be exact, but something in that ballpark. Well, what is it that's creating or causing that massive gap? Well, a lot of it, some of it's due to fees and other things, but a lot of it, and I would say most of it, is likely due to this exact issue. People making bad investment decisions when the going gets tough, when their emotions are high, and you know they're just trying to figure out, well, what do I do? I get scared. I just lost some money. I don't want to lose any more money. Things were really great when I was gaining money, but losing doesn't feel so good.
Nope.
So anyway, Rod, why don't you kick us off and start talking? Let's jump into the first bias. I think we've got 6 or 7 that we're going to hit on. Yeah. And we'll just go through them one by one and make sure that we're understanding what those are so that we're creating kind of an awareness. And hopefully by doing that, we'll be able to overcome those biases and push back against them. Okay, kick us off.
Okay, we're going to talk first about overconfidence bias. And in the conversation doing this, it's close brother familiarity bias. Okay, so overconfidence bias is just basically the tendency for individuals to think that they know more than they know, or have more confidence in their abilities than is actually there. Okay. I've got a great example of Christian's overconfidence bias.
Okay. I'm laying it out on the line here. So a few years ago, right, we'd already started the pod, so people hear me talk about this, and I haven't changed my belief system on this. However, when it was right in the COVID time, right? So we had that massive drop in the market. I decided at that time, like after the market drop, that I was going to put in like $100,000 into just stocks, right? So there's like 25, 30 stocks that I put money into. And it was over the next about 2-3 months, it proceeded to go from 100,000 to like 230,000, right? So it was looking pretty good. But I never had the intention to be like, try to make a quick buck and leave. So I had every intention of picking stocks that I liked for the long term. But here's the deal, Rod. It was easy for me in that situation to feel like I really just knew what I was doing, right? I was like, I know how to pick stocks with the best of them. Look at how but the reality is like, all right, if I was smart enough, and, luckily I have been, but if I was smart enough to realize that this really had very little to do with me and more to do with timing. Well, here's the end of the story. Since then, that same 100,000 went to 229. It went back down to 109 and now is at like 145. Okay. Right. So, but my point here is just to say, like, it would be easy for somebody after they've had a couple of big wins to start to feel like, oh, this is easy. I could just like, this is what I do. I keep rolling with it. And that's a good way to potentially like, blow it up and lose a lot of money. So anyway, that was just the thought that came to my mind as you were talking about overconfidence bias. Yeah. Well, and I would say that this is one of those things that is true in investing, and it's true in a lot of other places as well. For some reason, just investing. Exclusive. No, I'm just kidding. With the World Wide Web and just all this kind of thing, especially for people who are well educated, we get used to knowing what we're talking about. And so sometimes, again, I'm not saying this is true of everyone all the time, but sometimes we might, for example, read an article that addresses a certain issue, and all of a sudden we feel like we know everything about it. Right. Oh, yeah, that's easy.
overconfident, we get over we're just feeling like we know more than we know, and a little bit of knowledge about something just gives us too much confidence. So the thing that we want to be careful of in this case is feeling like, number one, that we got it figured out. Now and for always, we know what we're doing, and nothing can, knock us down, because that's a rough place to be.
Okay, I have a sneaking suspicion, Rod, that very few people listening to this right now are feeling overconfidence bias in this very moment.
Probably. And what they're probably thinking to themselves is, yeah, I can relate, right? Because here's an example that I often use as well. We very frequently have people who reach out, and we're having a conversation. They say, I figured it out. I know what the best place to invest in is, and that's where I'm going to put all my money. Right?
Okay. Very frequently, Rod. Occasionally.
Okay. Admittedly, they don't do it, right? People aren't actually out doing this, but in their minds, it's just this mental track of, oh, I figured it out. If there's one place that's the best, then that's just makes sense. I should put all my money there.
That and I'll say this, like there those people exist. There's no question. It's kind of like the flat earthers. It's usually extremists, and it's usually precious metals. Let's be real. Like that's usually
precious metals, but
not always, but oftentimes. Okay.
Well, in the recent past, it was multifamily. And,
well,
and then this
world,
goes back to the.
In that world, it's a little different than the same extremism that you get with people putting all their money in gold, right?
Agreed.
But you're absolutely right that there has been an overconfidence that exists in multifamily. But again, like the hard part is multifamily's obviously been hit pretty hard lately, mm-hmm. and so that's an easy one.
Yeah.
And yet I think about it as a whole, and like we're seeing hits on a lot of fronts, right? So It is kind of a hard thing, but I totally agree that we saw too many people be going too far into that, probably for a lot of the biases that we're going to talk about, overconfidence being one of them, but a lot of it was just like, hey, like, well, we're going to get into it. Things like familiarity bias, right?
Right.
And that just becomes easy. It's hey, I did it once. It worked great. It's easier than going out and finding new places to invest. Yeah. I'll just keep doing the same thing with the same people because I got a good result and it's easy.
Absolutely. Yep. Totally agree.
Okay. So that is an important one. Confirmation I jumped the gun. Overconfidence bias, familiarity bias. Those are just things to be aware of, just things to be thinking about as you're investing. So if you're that person, it's a good opportunity to kind of take a step back, look in the mirror. Okay, the next one we want to talk about is loss aversion, Rod. Everybody feels this to some extent, mm-hmm. right? Nobody's like, I love losing money. Like, I love it. At least I don't know very many people. There might be a few that are just like that wise that they're like, I love when there's a big like hit in the market because that means I'm going to be able to snatch up opportunities. Like, there's going to be some of those people, but the loss, like we all have some aversion to loss. I think the question is like, how do we keep that from, being the primary decision maker, like driving our decisions, and we just, allow it to have the space that it probably needs to without, taking over things. So what's your take?
Well, we talked about overcoming emotional biases, and probably the strongest emotional bias or emotion that creates biases is fear, right? Fear of what may happen. In this case, losing money leads to fear of, well, what's going to happen to me? Am I going to lose my home? Am I going to lose my business? Am I going to be able to retire? Whatever, right? Am I going to lose everything because of these losses? And again, I'm stating it in the extreme intentionally because that's what fear does to us, right? It makes us start to think irrationally. And if we're doing things the right way, we need to be putting ourselves in a place where we are taking on risk, right? There's no way to not take on risk, right? Let's just put it that way. But if we let the fear make our decisions for us, then we're just not going to make very good decisions.
So the definition that they had here, which I think is interesting, is the tendency to prefer avoiding losses over acquiring equivalent gains, right?
Yeah.
So that's the balance. Like, it's normal and reasonable for all of us to have an aversion to loss. The question is that aversion so strong that it's keeping us from making good investment decisions? And if it is, obviously I need to, kind of reset and come up with a way to overcome that. We're going to talk about ways to overcome it or things to be doing that can help in just a minute. Okay, next, Rod, let's talk about confirmation bias. The definition is the tendency to search for, interpret, and remember information that confirms one's perceptions. Okay, shocking. How do you see this playing out in the investment world?
Yeah, so this one is one. I was communications major in college. Okay, so as part of those classes, we talked about some of these things, and the term that I remember as it relates to this one is cognitive dissonance. In other words, I'm looking for ways to continually reinforce the decisions that I've already made, because if I admit that I was wrong, then that makes me weak or whatever. But if I continually, again, reinforce, well, I was right, then I feel better about myself, right? Just that. Now there's the psychology of it, right? But the problem is that when in reality, I know I'm not perfect. I know I don't always make the best decisions possible. So I have to be willing to look at myself honestly and realize and improve, right? I mean, that's kind of the whole idea of learning from our mistakes, is we can become better by doing that. If I refuse to let myself believe that I made mistakes, I'm not going to be able to improve.
The most prominent places that we oftentimes see confirmation bias is in money, politics, and religion, right? And the reason is because these are like our deepest held beliefs. Like, these are the things that are deep rooted in us. These are things that permeate our entire lives, right?
Yep.
That's just the way it is. And so it becomes really easy. And by the way, this is why there's this massive the divide between all of these things, because each person carries with them their confirmation bias. So here's what I'm not going to claim. I'm certainly not going to claim that we have the advice that's going to help people overcome their confirmation bias, especially as it relates to politics and religion. However, the good news is money is a little bit easier, right? Like politics, religion, money is a step below that as far as pain, in terms of changing some of those deep-rooted beliefs. And the good news is all I have to do is look at the data, understand, take some time to become educated. And when I do that, it becomes a little bit easier to start making decisions that are less rooted in the things that I've already done, my confirmation bias, and more rooted in actual facts, knowledge, understanding, so forth.
Yeah. And seeking out information on topics that you know nothing about. If I'm only ever paying attention to things that confirm or line up with what I'm currently doing, then I'm not allowing myself to get those different points of view.
That's not a very healthy way to go, is it? And again, I believe that's not a healthy way to go in any parts of life, but in money, that'll specifically lead you to here's the thing. The stuff that you're doing, the strategies, the techniques, the investments that you're making should hold up to scrutiny. Like, they just should, right? If you can't put it out there and be able to stand behind it, then the chances are it's rooted in something other than fact and, what's a better truth, right? It's oftentimes rooted in one of these biases. And again, that's when we have to take a step back, look in the mirror, and hopefully make some change. I felt like a little like Michael Jackson talking about the man in the mirror. Okay, we won't sing it for everybody's sake. Okay, so we talked about loss aversion, talked about confirmation bias. Let's talk about a couple more, Rod. We've got herd mentality.
Yeah.
That's pretty easy, right? We kind of know what that, and really, I think you brought up the multifamily thing. That's certainly an element of what we've seen there, right? If you get into a group where everybody's awesome in multifamily, it's easy to become and I know a lot of people are going to be like, well, that's, here's the deal. We're not immune to this, right? We absolutely believe in multifamily as a great investment class.
Yeah.
Having said that, it can't be the only one, right?
Yeah.
And unfortunately, too many people probably learned that the hard way, or are learning that the hard way. But hopefully it can be a learning experience so that as we move forward, making good decisions, and then hopefully at the same time, we're making good decisions as it relates to the investments that are out there that may not be performing the way I want to. So part of the reason I wanted to bring this subject up is because we know a lot of people who have done really well in the investment space, who make a lot of money, but who have also lost money over these recent times. And now they're in this space where they're having to determine, what do I do with these investments, right? Like, do I try to ride it out? Do I try to make some, sudden changes to mitigate losses? Like, those are all things we have to be thinking about. And I guess the advice I would have to people is take the time to think about it, right? Like, that's probably the best thing I could do. We're going to talk about, again, a couple of ideas that might give us a better starting point. But if I'm already there, what do? I just have to kind of fight it, right? I have to be willing. Again, I keep saying it. I got to be willing to look in the mirror and see if that's what's happening. Well, the good news is it's easy to see right now because of kind of the challenging situations that we're having. But it also means that there's a lot of good opportunity from an investment perspective. So if I'm one of those people that's that's trying to figure out what to do. And by the way, I'm not saying one option is necessarily better, right? In every situation, you shouldn't ride out your investment, even if it's struggling. There are some situations where you absolutely should, right? Sure. But those are the things I have to balance out. And of course, it's hard to do that while I'm simultaneously battling against all of these different biases. And herd mentality certainly applies to that.
Yeah. And here's one thing to think about as it relates to this one is if you ever find yourself thinking, well, a bunch of smart people are doing this, and why would they all, get in on this investment if there was something wrong with it? If that's the basis that you're using to get into it, then take a step back and either just walk away or do the work, do your own due diligence to understand it and make sure you know why those people are getting into it. Because just because smart people do it doesn't necessarily mean it's a good match for you anyway. Right. So, one other thought on this too is that it's kind of like a FOMO thing a lot of times, right? If it's so good and so all these people are getting into it, I don't want to miss out on that. I want to participate in all the wonderful things that they're getting over there. So I'm going to participate. And again, if that's the only reason why you decided to jump in, take a step back.
So it's a great starting point, right? A lot of these things can be a good starting point. Having that, that friend that's an investor that's really a really good investor, looking at things that they're doing is absolutely a logical starting point. To your point, it's that next step that I have to be careful about. I have to make sure that I'm not making that decision because of that. But that's, again, just kind of what's got that initial intrigue. Yeah. So now I will say this, right? We have to rely at least somewhat on experts. And so the key there is to make sure that I'm relying on experts with a track record that have a good reputation for doing what they do and being transparent and honest and doing it the right way. That's the best I can do in that situation. So, but again, all of these things can be really hard when the herd's saying, do this, and you're having to kind of push against it. But, Rod, that's also oftentimes where the greatest opportunities lie if I can push against that herd mentality, do something different. And that's really what we've seen in the alternative investment space as a whole, right? So much it's like a 90-10 out there, right? 90% of people are in the traditional space, 10% are in the alternative space. And our experience suggests that those 10% are reaping massive rewards because they're willing to push against that herd mentality. But be careful not to have it in the alternative space either.
Yeah, exactly. And what's interesting is sometimes it's the herd mentality that creates a bubble, right? And then later the crash. The example that comes to mind was GameStop. Remember that whole thing here in 2021?
I remember GameStop.
And the price was down to like $2 or something. And then because of this herd, it drove it up to like $380 at its peak. And then a month later or whatever, it was back down to $10. So if you bought at $3 and you sold at the $380, congratulations. But what we know is volume pushing it up to that price point means there were a lot of people that bought it above $10 and then came back and were like, oh, shoot. Okay, I guess I'll just sell it and walk away. You know what I mean? Yep. So a lot of people lost money on it. Again, especially if they were the later implementers following the herd.
Yeah, and that is a great point, right? Like the generally the worst place you can be is at the end of the herd. Yeah. Right. So don't be that person. Yeah. So that's a really good tip. Okay, Rod, let's move into some tips. We've talked about most of our, is there any others that we wanted to hit on that we didn't?
The one last was availability bias.
I think this one's important. So let's touch on it.
And this one is, well, I mean, we make decisions based on information, right? But if we only are making decisions based on easily accessible information or just the recent information, then a lot of times what it does is it causes us to overreact in a short-term type of market situation, and we lose track of the long-term. So, and it relates to a lot of the things we've already talked about. But the point is that we have to be willing to dig deep, like create a system, create a process. Again, we're going to talk about this in a minute, how we can make things better. But the point is, if it's, a lot of times people say it's too good to be true, right? And in a lot of situations, it's not necessarily too good to be true, but it's too good to be easy, right? Too good to be an easy decision to just say, oh, hey, that sounds like a good story. I'm on board, based on limited information that's just easily accessible. If I do the work and dig deep and find out, hey, this really is good, I'm in. I'm doing it because I actually did my own due diligence.
You're getting way too philosophical for me, Rod. You've lost me. Let me just give you a really quick example of where I see this and makes it. You talk about it all the time. The ease of investing my money in a 401k is a perfect example of availability bias. It's right there. It's easy. Everybody's doing it. All I have to do is defer it out of my paycheck. I click a box and suddenly I've got XYZ percentage of my check going to that is availability bias at its finest.
Yes.
So fight the availability bias because oftentimes it will lead you astray. Okay, Rod, we're going to get preachy, but just for a minute, because we've already done some preaching and I don't think anybody's really that excited about hearing us preach. So let's tread lightly as we go through this. Okay. But let's talk about at least a few ways that are a few things that people can do to try. Again, we're not pretending to be experts here, but to try to overcome some of these biases that are just always going to be there. Okay. Step one, Rod, setting clear investment goals. So that feels obvious. It seems obvious. And I would dare say that most people don't do it. Like we might have something in our head, but that's not the same. So if you're listening to this and you're like, of course I've got goals. I'd like to become generationally wealthy and XYZ. Like that's probably not what we're talking about here. We're talking about more specific investment goals that I can cling to when I'm having to deal with the emotions, right? Yeah. So that's where it becomes really clear when things are nutty in the market or in my real estate portfolio, I've got to have a foundation to latch onto. And that's where my investment goals are, right? That's what that's why those exist.
And that's because they lead to a plan, right? So you have a long-term plan and that creates a track that you could run on, knowing that you're going to run into hiccups along the way. So when you run into those hiccups, to your point, we don't get carried away in too far in one direction or the other by the emotion of it.
Absolutely. Okay. Setting clear investment goals. Number 2, diversifying investments. We've talked about this a lot, right? A lot of these things tend to lean us toward going all in on the things that are working or what's available or what other people are doing. And in reality, there is always going to be some value in diversifying. Now, we obviously, I don't like the mantra that it's like, hey, just diversify to diversify. That's not what we're talking about. We're talking about like genuinely looking at ways that I can overcome potential issues that might come up in one investment with investments that are running contrary to that situation, right? So oftentimes people talk about it in like having various mutual funds. We like to talk about it in having actual different asset classes. And it is different things within those asset classes, but we want to be at that baseline, like real diversification, not that like, facade diversification that we get when we're like, hey, I went from 10 mutual funds to 15. That's not what we're talking about. Not that that's not valuable or can't be a good thing, but again, that's not what we're talking about here.
Yeah, diversify within the asset class and diversify into multiple asset classes.
Absolutely. And different time frame. There's all sorts of things. Now, I say that, and I feel like sometimes it can become like overwhelming. You're like, oh gosh, I've got to have staggered investments. I've got to have. It really doesn't have to be like I can have some core asset classes that I work with. Again, we're just saying don't put all your eggs in one basket. Make sure that you're smart about that, and you're not. And again, the bigger issue is if you're making the decisions you're making based on the biases that we've been talking about. That's where the red alarm goes off.
Yeah. You have to diversify to get exposure to different risk profiles.
Okay. We've talked about setting clear investment goals. We talked about diversifying investments. Rod, talk to us about the importance of maintaining discipline.
Well, really, it's just saying keep doing the first 2, because if you set the goals and you created a plan, but you're not sticking to it, you don't have the discipline to stick to it. Well, that's a problem, right? You may as well have not done it. And diversifying, it really does take discipline, because when things are going so well in one spot, you don't want to move away from it. You don't want to think about anything else, but you have to. You just have to force yourself to do it. So, and so build it into the plan and then do it. Right. And that's why, in the traditional world, they rebalance portfolios, right? Something has done really well to create this imbalance of the percentages, and discipline says, well, you have to rebalance those, because the stuff that won yesterday, you can't count on that winning tomorrow, right? The stuff that lost yesterday actually might be in a really good position to win tomorrow because of that. Right. So there are a lot of reasons why it's important to do that. And again, you just have to force yourself to do it.
Okay, Rod. And our final piece of advice, this is like sage wisdom, right? You ready for this? Here it goes. Write it down, everybody. Write it down. Just remove the emotion. No big deal. Yeah. Just remove emotion from your investment decision. So you can pretty much forget all the rest of the stuff we say. Just base everything on fact, remove emotion, and you'll be good.
Yeah.
Okay. It does say in like quotes, try to remove emotion.
Yeah, I had to put that in parentheses before that. Try to remove.
And I'm glad that you did, because the reality is like nobody removes emotion entirely, right? Like that's not even. I don't even know that that's possible. It's not possible. So here's the deal: we almost have to say like keep emotions in check. Yeah. Right. Yeah. Check your emotions at the door. Maybe you have somebody that you bounce things off to help keep because here's the thing. Maybe you're like the king or queen of emotional maturity, but for the rest of us, like it might be useful for us to have resources or people that we look to when we're trying to kind of figure out those emotions. So anyway, it is important to try to remove emotion to the best of your ability, but maybe the best advice I could give is to check it from people and resources that at least give me a chance to put it in perspective.
For sure. This goes back to what you were saying earlier, politics, money, religion. To the extent that we let our emotions take over us, we become irrational. right? And you see the just the fights that people get into, and you're like, this is out of control.
It's usually one emotional, irrational person versus another, right?
Yep.
Although I will say this, sometimes those can be all sorts of fun to watch.
Entertaining.
They can be very entertaining. In fact, Rod, I'm hoping to announce a debate that I'm going to be on here in the next few episodes. I'm going to keep it under wraps because we haven't formalized it yet. But on that note, I'm hoping in the next few weeks to announce it. Okay. Before we go, I just want to one more time shout out to the virtual summit, September 12th. Make sure you don't miss it. Damon John, along with a host of other incredible speakers. So we're very excited about that. And I want to say thanks to everybody for listening to the show and sticking with us. And we hope to see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.